right, welcome to Iron Financial. We're the show that forges stronger portfolios by hammering through market weakness and finding what's real. Today, B&G Foods is on the anvil. Now you know these guys. Cream of wheat, Green Giant, Ortega, their products are probably in your pantry right now. These are what we call bedrock assets, absolute legacy brands. But here's the problem. The corporate structure holding it all together, it's showing deep, dangerous stress fractures. Management has this big blueprint laid out to rebuild, but the whole thing is sitting on a seismic fault line of debt. So our job right here, right now, is to stress test their plan. Are we looking at a solid reconstruction? Or are we just watching them build a house of cards right in the middle of a hurricane? Let's get to work.
Whoa, hold on a second. Let's just pause on that. Spice Islands, Crisco, Clabber Girl, I mean, come on. These aren't just brands. These are American kitchen staples. You'd think these are the most defensive, recession-proof things you could possibly own. They should be printing cash day in and day out. So the first and, let's be honest, the most important question any investor has to ask is, how on earth do you screw this up? How does a company that owns this much prime real estate in the American psyche end up on the ropes, getting crushed by nearly $2 billion in debt? This tells me right away it's not a product problem. This is a management problem, a strategy problem. Something is structurally rotten in the financial architecture of this company. And that's what I need you to break down for me first. Where did the rot actually start?
You're asking the right question, and that's exactly where we have to start. You can't possibly evaluate the rebuild without first walking through the demolition site. Before we even look at their turnaround plan, we have to understand the sheer, crushing weight of the numbers pressing down on this company. I want to be crystal clear. This isn't some minor repair job they're undertaking. This is a company fighting against immense financial gravity that was created by years and years of questionable decisions. So let's dig into the raw data. This is the foundation of the entire bull versus bear debate, and believe me, it is not pretty. Let's start measuring the cracks.
Here it is. This is the number that defines the entire story. $1.95 billion. That's the long-term debt sitting on their balance sheet. And if you want some perspective on that, their entire market capitalization, what the stock market says the whole company's worth, often struggles to be even half of that number. Think about that. This isn't some abstract figure on a spreadsheet. It is a massive anchor chained to the company's ankle. Every single strategic decision, every dollar of potential profit, every single operational move they want to make, it's all dictated by the need to feed this colossal debt monster. It just strangles their flexibility. It magnifies every single risk, and it is the #1 reason the market is treating this stock like it has the plague. This is the hole they have to dig out of, and it is incredibly, incredibly deep.
Right, and that billion-dollar anchor leads directly to this number, 4.29. That's their debt-to-equity ratio. Now, for everyone listening, this number basically tells you who really owns the company's structure. And in this case, for every $1 of equity, the part the shareholders actually own, there are $4.29 of debt. To be absolutely clear, in the consumer staples sector, a healthy ratio is somewhere around 1 to 1.5. B&G is operating at nearly 3 times the high end of what's considered normal. This isn't just leveraged, it's dangerously, recklessly over-leveraged. It's like they built a skyscraper where the banks own the entire steel frame and the shareholders just own the drywall. Sure, it might stand on a calm day, but the second a strong wind blows, an economic downturn, an interest rate shock, that entire structure is at risk of catastrophic total failure.
And that pressure, that immense pressure from all that leverage, is already causing a structural failure on the bottom line. Look at this, negative $43.3 million. That was the company's net loss for fiscal year 2025. This is a critical point of failure. You have to understand this. They aren't just carrying a mountain of old debt from the past. They are actively losing money right now, in the present. The structure isn't just overloaded, it is literally bleeding cash. And that creates this vicious downward cycle. The interest payments on their $1.95 billion in debt are so huge that they can't turn a profit. And because they can't turn a profit, they can't generate the cash to pay down the debt. You see the trap? That's the financial quicksand they are stuck in.
Now, this number here shows us that the cracks are starting to appear in the asset base itself. $70.6 million. That was a goodwill impairment charge they were forced to take. Let me break that down. In simple terms, goodwill is an accounting item for the extra money a company pays for an asset above its physical value. Basically, you're paying for the brand name. So an impairment charge means the company and its auditors are standing up and officially admitting that an asset they bought is no longer worth what they paid for it. It is a public confession of a past strategic failure and terrible capital allocation. And specifically, this charge was taken against their frozen and vegetables unit. It's a flashing red light that a key part of their portfolio wasn't just underperforming, but its actual value was fundamentally eroding.
And this table, well, it lays the entire problem out in plain black and white. Just look at the balance sheet. Total assets, right at the top, just over $2.8 billion. Okay, but look right below that. Total liabilities are nearly $2.4 billion. You do the math. That leaves just $453 million in total stockholders' equity. That's it. That is the entire buffer. That is the company's whole structural support system. And now, look at the change from the year before. Stockholders' equity has shrunk by over $70 million in 1 year. The foundation isn't just thin, it is actively crumbling. What this balance sheet screams, what it tells you in no uncertain terms, is that the margin for error here is razor thin. The cushion is gone. The weight of what they owe is immense.
Okay, so the picture you've painted is frankly grim. A mountain of debt that makes the company's value look tiny, they're losing money, the equity base is shrinking, and they're admitting they overpaid for key assets? The building is fundamentally unstable. So, what's the plan? Does management have a credible blueprint to actually fix this mess? I need to know, are they just patching holes with duct tape and hoping for the best? Or are they finally bringing in the wrecking ball for the serious demolition and reconstruction this thing so clearly requires? Show me the plan. I want to see some real heavy lifting.
They do have a plan. And you know what? It starts with something pretty drastic: amputation. These are the words of the CEO, Casey Keller. And you have to understand, this is an incredibly direct admission of a long-term strategic mistake. He's openly saying that the Green Giant frozen business, a flagship brand we all know, was just a bad fit. The key phrases you need to focus on are seasonal production, geographic complexity, and higher working capital intensity. In plain English, what he's saying is, it was a complicated, cash-hungry beast of a business that just didn't fit with their core strengths in shelf-stable foods. This quote is management's entire justification for the first and probably most painful step in their reconstruction, cutting off a famous part of the business that was dragging the whole structure down.
And this wasn't just about selling off a problem child. It was a very deliberate, strategic swap designed to reinforce their core structure. Think of it like a sports trade. On one side, you have the divestiture of Green Giant Frozen. As the CEO basically admitted, it was ill-fitting, complex, and, get this, according to their own earnings call, it was contributing zero EBITDA. For our listeners, EBITDA is a core measure of profitability. Zero. So they were shedding absolute dead weight. On the other side of the trade, they acquired Kitchen Basics broth. This is a core, shelf-stable product, exactly the kind of thing B&G knows how to manage. And crucially, it is EBITDA accretive, meaning it actually adds to their bottom line. They are trading a complex, zero-profit headache for a simpler, profitable business. This is portfolio surgery in its purest form.
Okay, I see the logic. It makes perfect sense on a whiteboard in a boardroom. You cut out the diseased tissue and graft on some healthy tissue. Great. But let's get real about the scale here for a minute. We are talking about a nearly $2 billion debt problem. They're selling a business with no earnings and buying one that, according to the call, generates pretty nice EBITDA. What in the world does pretty nice mean in actual dollars? 10 million? 20 million? Because if that's the number, that's a rounding error on their debt. So is this one little swap really powerful enough to change the entire trajectory of a company this deep in the hole? Or is this just rearranging the furniture in a burning building? It feels like a smart tactical move for sure, but I'm seriously questioning if it's a big enough strategic weapon to fight a war of this magnitude.
And you're absolutely right to question the scale. That is the billion-dollar question that the market itself is wrestling with right now. If you watch the stock, it initially dropped on all this news, and then it surged. It was chaotic. To understand whether this plan has any real teeth, we have to do something important. We have to ignore all the noise from last quarter's results and focus entirely on what management is promising for the future. We need to cut through all that static and analyze their forward-looking guidance. This is where the bull case is either forged in steel or it's revealed to be hollow.
This data right here tells the entire story of the market's split personality. The initial reaction, the bad news, was based completely on looking in the rearview mirror. Q4 earnings per share missed estimates by over 7%. Adjusted EBITDA missed by almost 3%. So the market saw this backward-looking data, and predictably, the stock slipped about 2.5%. But then, the analysts and the serious investors started digging into the guidance for the future, the good news. The guidance for 2026 earnings per share didn't just meet expectations, it blew them away, beating them by a whopping 17.5%. The EBITDA guidance also came in strong. And the result? The stock did a complete 180 and surged 12%. This tells you everything. The market has written off 2025 as a lost year. This is now a show-me story, and the bet is entirely on management's ability to deliver on these 2026 promises.
And this right here.
This is the number that the entire bet now hinges on, 60 cents. This is the midpoint of management's adjusted earnings per share guidance for fiscal 2026. After a year of bleeding red ink, they are guiding for a definitive, significant return to profitability. This single number has become the new load-bearing pillar for the entire bull case. Everything, absolutely everything, depends on this. If they can hit this target, it proves the portfolio surgery actually worked. It proves they can generate the cash needed to start seriously chipping away at that mountain of debt. Every single investor watching this company has this number circled on their desk. It is the pass-fail metric for this entire management team.
So hitting that 60 cents per share target is the path. This number, this is the destination, 6.0. This is management's target leverage ratio, specifically its net debt to pro forma adjusted EBITDA, for the middle of 2026. Now, this is a different metric than the debt-to-equity ratio we saw earlier. This is the one that the creditors, the bondholders, the people who really own the company, this is the one they watch like hawks. It basically asks, how many years of earnings would it take to pay back all the debt? By putting this number out there, management is making a very public promise to the banks and the bond market that they have a credible plan to de-risk the company's financial structure.
Hold on a minute. Let me get this straight. The goal, the best-case scenario that they are actively aiming for, is a leverage ratio of 6 times EBITDA? 6? In today's world, with interest rates where they are, a 6.0x leverage ratio is still deep in high-risk junk bond territory. Let's be real. A safe, comfortable level for a stable company in this sector is under 4. Their grand plan, their victory lap, is to move from the intensive care unit to a regular high-risk ward in the hospital. That's not a foundation for growth. That is a foundation built on the desperate hope that nothing else goes wrong. It leaves them zero room for error. No room for a recession, no room for a supply chain shock, no room for a spike in commodity prices. They are literally telling us their master plan is to move from critically unstable to merely dangerous. That's not a plan I want to bet my money on.
And that is the absolute core of the risk. You've nailed it. The margin for error in this entire plan is zero. It's non-existent. So for our final verdict, we have to lay out the precise, incredibly difficult path that this management team must walk. This is not a simple buy or sell recommendation. This is a bet on flawless, perfect execution against a backdrop of significant, persistent risk. Let's outline exactly what has to go right for the structure to stabilize and what could cause a total, catastrophic collapse.
The bull case, if there is one, rests entirely on this 4-step path, what we're calling the iron path to stability. And let me tell you, there are no shortcuts on this path. Each step is a critical, load-bearing pillar that has to be perfect. First, they have to finalize all the announced transactions without any hiccups, any snags. Second, they have to integrate that new broth business seamlessly and prove the synergies they promised are real and profitable. Third, and this one is completely non-negotiable, they absolutely must hit their 2026 guidance numbers. That 60 cents of earnings per share is the number the market has to see, period. And fourth, they have to take every spare dollar of cash flow and use it to aggressively, relentlessly pay down debt to show the creditors they are serious. If, and believe me, it is a massive if, they can execute all 4 of these steps perfectly, then the structure could hold.
So here it is, the final breakdown. The bull case goes like this. Management has finally woken up and faced reality. They are performing the difficult but necessary surgery that, frankly, should have been done years ago. They're shedding the complex, unprofitable assets and refocusing on a stronger, higher-margin core business. And their strong 2026 guidance isn't just a wild guess. It's a credible blueprint for recovery. If they hit it, the stock is dirt cheap right here. But the bear case is just as powerful, and it's a whole lot simpler. The debt load is still immense. Their target leverage of 6 times is still squarely in the danger zone for this interest rate environment. This whole plan leaves them with no safety net, no shock absorbers, nothing. One unexpected economic event, one misstep in their perfect execution, and the immense weight of that debt could cause the entire structure to come crashing down. This is a high-wire act with no net, and the winds of the market are notoriously unpredictable. It is a bet on absolute perfection, and 9 times out of 10, that's a losing bet.
So that's the question we have to leave you with. Management is finally swinging the sledgehammer. They are laying new support beams, the moves they're making are logical, the plan they've laid out is clear, and the guidance is strong. But are they just building a prettier version of the same unstable structure on top of a cracked foundation? Is there enough time, enough runway, to finish this high-stakes construction project before the next economic storm inevitably hits? That is the stress test you need to run for yourself before you even think about putting capital to work here. Thanks for joining us on Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.